Hey guys, I hope you and your families are doing well. The purpose of this video is, it's a video that I would have loved to see myself over 10 years ago when I started my trading journey. I'm going to cover lots of different areas of trading, so more than the mechanical stuff that you've probably seen videos on, like setups, entries, things like that, but also go into some areas that are never really discussed, like the darker side of trading, actually speaking about the bouts of anxiety, fear, depression, high levels of stress that you're likely to experience during your trading journey, and things that I've done myself to kind of cope with that and help and try and thrive with that as well. So if you like this video, I'd really appreciate it if you can subscribe to the channel, share the video, press the like button. It really does help me out with the YouTube algorithms. If you want to leave a comment down below, then I will personally respond to you. You'll see timestamps as well, so you can fast forward, you can rewind to parts of this video you may find of interest. MarketSmith are the sponsor of this video. You see a couple of MarketSmith charts throughout this presentation. If you're interested in a discounted MarketSmith chart, then there is a link down below. So let's jump on into it. So these are some of the areas that you're going to be learning in this video. I'm going to teach you that there are 4 parts of every trade, and I've got slides prepared on all of these. So identify, control, mitigate, and optimize. Then there's other important areas that you are going to learn about. You're going to learn about the importance of you. You're going to learn about my biggest mistakes. You're going to learn about the power of compounding. You're going to learn about deliberate practice, progressive exposure, and portfolio management. How many stocks do you want to hold? So let me start going through this, and I just want to give you an overview. So I'm not going to read all of these out to you. You can see them on the screen. I want to try and keep this video a little bit shorter if possible. So this is an overview of what you're going to learn during the different areas. So that's your overview for identify. You've got your overview for control. So we're going to be going into the weeds in terms of optimal reward to risk ratios, understanding more about risk management. I'm going to teach you about mitigation, so free rolling trades. I'm going to teach you the math behind it as well, and active risk mitigation tactics. We're going to be looking at optimizing profits. I'm going to show you some statistics. I'm going to speak to you about the 80-20 rule. I'm going to talk to you about things that you didn't learn about selling. We're also going to go into the mental side of things, so the importance of you. I'm going to go into the darker side of trading. Mindset is a skill set. Being aware of internal dialogue and belief systems, and daily and weekly habits that you can be using to improve your mental performance. I'm going to take you through some of my biggest mistakes. These basically list out all of my biggest mistakes. 2 of the biggest ones are actually probably, well, 3 of the biggest ones is, and all of them are really important actually. Just not cutting losses, believing in stories, selling winners too early, terrible trading mindset, paying the price of ignorance of not working on myself. We're going to be going deep. In this video, we're going to be looking at the power of compounding. How on earth did Warren Buffett make billions? I'm going to be showing you that, and compounding. I'm going to be teaching you about deliberate practice, how you can become an expert performer in any field of endeavor, how you can create your own deliberate practice routines. I'm going to be teaching you about progressive exposure, when to go hard and when to go golfing, analyzing market and trade feedback, analyzing you as well. So let's get on into it. So we're going to start off with identify. Now there is a price cycle, and this price cycle is for indexes, it's for ETFs, it's for individual stocks as well, it's for commodities. It is just cyclical. As much as life is cyclical, and you get the seasons of life as well, and you get the seasons in the weather as well, it's the same principle for stocks and the price cycle. So there are 4 main areas. There is the phase 1 accumulation, there is the phase 2 uptrend, there is the phase 3 distributional top, and there is the phase 4 markdown. So when you pull up a chart, and I'm going to show you zoom in a minute, when you pull up a chart, it's important to try and identify where are you in the price cycle, because this video is specifically aimed at breakouts. So you need to know, well, where am I in the price cycle? Am I in a powerful phase 2 uptrend, which is a lot of your favorite trading books, Darvis, O'Neill, Minervini, Jesse Livermore? They would often be buying stocks in confirmed phase 2 uptrends. Or are you actually in a phase 4 downtrend where price is below all of the key moving averages for whatever time frame you're on? So say if that's on the daily chart, price might be below the 200 SMA, the 150 SMA, the 50 SMA, whereas in a powerful phase 2 uptrend, price is likely above all of those key moving averages. It's above the 200 SMA, it's above the 100 SMA, it's above the 50 SMA, maybe above the 21 EMA as well. So it's important to think about, where are you in the price cycle? So here's an example of Zoom, which you have probably likely used as well. So Zoom, good indication of the price cycle. Phase 1 accumulation, powerful phase 2 uptrend. This is on the weekly chart. So it's above the 10 week, it's above the 21 week, it's above the 40 week as well. Then it goes into the phase 3 distribution top and then into the phase 4 downtrend. So it's important for you to look at it and look objectively and contextualize it. Where is this stock? Where is this ETF? Where is the index? Is it in a phase 2 uptrend? Is it in a phase 3 distribution top? Is it in a phase 4 downtrend? Because I'm going to build on this later on when we look at when do breakouts work best. And I'll give you a clue. It's when the longer term trend is on your side and that proverbial tide is lifting all boats. So phase 1, phase 2, phase 3 and phase 4. You need to be aware of where is the stock, where is the ETF in the context of the price cycle. So let's say you identify a stock that is in the context of a powerful phase 2 uptrend, or it's just coming out of a phase 1 base. What are the best 5 breakout setups to be looking for? Well, here are the 5, and we're going to start off with the cup and handle. So we're looking at all of these in the context of, let's say, a powerful phase 2 uptrend where the stock is above its 200 SMA, 150 SMA, and 100 SMA. And we're going to imagine that this purple line here, for these examples, let's just imagine that it's the 50 SMA. Okay, so it's the 50-day moving average, this purple line here. So with a cup and handle, you'd like to see the stock in a nice uptrend. Also imagine that this is above its 200 SMA, so it's in kind of a confirmed uptrend. Now the cup and handle should resemble a cup, this being the cup and this being the handle. Now I don't want to go really into the weeds here, but visually you should be able to see it. And then in the handle, okay, you're going to learn about Davis boxes, and you're also going to learn about VCPs in a minute. Within the proverbial handle here, you would like to see a little Davis box, a little VCP forming. Ideally, the share price starts putting in higher lows, the volume dries up as well on a relative basis, and then when it breaks out, you'd like to see high relative volume coming through, this green volume bar to indicate high relative volume coming through. The initial stop losses, we're going to be coming on to those a little bit later, so I'm not going to touch on those too much. But nice uptrend here, and it should resemble a cup and then a handle, and tightening in the handle, and ideally it's setting up and tightening around one or more key moving averages. To keep it nice and simple, I've just kept the 50 SMA on here. This is, if you've read Minervini's books, you'll be familiar with a volatility contraction pattern, a VCP. So with a VCP, let's imagine that it's above the 200 and this purple line is going to be our 50 SMA. So the stock is in a nice uptrend. It's generally finding support around the 50. And then with a VCP, when it's in an uptrend, ideally you would like to see, invariably you'll see 3 or 4 contractions. Now the depth of the contraction should be lessening each time and preferably building higher lows. So here we've got 1 contraction, 2 contraction, 3 contraction, then the breakout. So imagine if this here, the first contraction is 20%. So from peak to trough, this is 20%, then it bounces, then it's 10%, then it bounces, then it's 5%, then the breakout. Ideally you would like that final contraction to be in single figures and the stop loss place just below that, but we'll come on to thinking about initial stop losses. As the base is developing, you'd like to see more volume coming through on the rallies and then lessening volume on the pullbacks as well. And then as price builds out kind of that final contraction, you'd like to see the price action getting really tight and the volume drying up, so there's hardly any volume coming through. That indicates there's very little supply coming to the market. So a cup and handle, VCP. You also have a variation of a VCP, and you could think about this as a kind of pocket pivot as well. So imagine that this is our 50 SMA, and let's imagine that the 200 SMA is kind of sloping down here somewhere, so the stock is still in an uptrend. So price pulls back down, puts in a big shakeout down here, comes up, reclaims the 50 SMA, and here you start to get that volatility contraction pattern action. So volatility in this region is decreasing, so volatility contraction, volatility is decreasing in terms of the price action, and then look how the volume is sloping down as well. So as you start to get these tight final contractions, the volume on a relative basis, ideally you'd like to see the smallest volume within the base, and oftentimes just before the breakout, you can actually see a really tight candlestick. Sometimes it can be an inside candlestick. It trades within the range of the prior day and the lowest volume thus far within the base. So that there is a low mid pivot VCP / pocket pivot. This one here, if you haven't read Darvis's book, I'd highly recommend it. So a Darvis box is basically a rectangle, also known as a flat base or a flat channel. I just call it Darvis box to give Darvis credit. I learned an awful lot from it. So let's imagine that the 200 SMA is down here somewhere, and this purple line is going to be our 50 SMA. So the stock's in a nice uptrend. And then it starts, it looks similar to a VCP, doesn't it? Okay, it starts bouncing, okay, around in here, and then volatility contracts. Look how the volume dries up from left to right. So ideally, you'd like to see increasing volume on the rallies, decreasing volume on the pullbacks, and then big volume coming through. So a Darvis box pretty much represents a rectangle. Let's go on to the next one, which is a high tight flag. So a high tight flag, let's now actually imagine that this purple line is the 21 EMA. Okay, so high tight flags are quicker. With a high tight flag, you'd like to see the share price go up over 100% in less than 8 weeks. So a 100% move in less than 8 weeks. And then the pullback from the peak, so the highest point of the base to the lowest point of the base, you'd like to see that less than 25%. So it's an indication that's a lot of strength. Oftentimes this move can be sparked by news. It may be news of this stock or a brother sister stock. It may be, if it's a biotech stock, it's FDA approval or something like that. Maybe it's no news at all, but you're looking for really positive price action, 100% advance in a short period of time, and then peak to trough not greater than 25%. If the stock goes up, say 500%, and then it pulls back 30%, apply a little bit of common sense with that. But ideally, you would then like to see price tightening, and it should display some kind of VCP action. Volatility should contract, the volume should contract and decrease as well, and you'd like to see the price action getting nice and tight and setting up on at least one key moving averages. So that could be, say, the 21 EMA that we're imagining here, but this could also be the 10 EMA. 10 EMA and 21 EMA, very important for the quicker stocks in the market. So that should hopefully give you a good overview of 5 chart patterns and thinking about them in the context, where is the price cycle? Now, what are the 3 most important fundamentals for growth stocks? Really, really simple, okay? It's earnings, it's sales, and it's also estimates. Earnings, sales, estimates, and estimates also include guidance as well. So this stock here, this is ANEP. And we're going to be talking about relative strength. These are the relative strength lines. So on the weekly chart, it breaks out of a very large VCP base, volatility contraction pattern base. Do you see how the depth of the contractions are roughly halving each time? You have 1 major contraction, 2, 3, breakout, and then some decent volume coming from the breakout. Take a look at the earnings coming through and the acceleration in the earnings and the acceleration in the sales as well. You also have it on a year-over-year basis and a quarter-over-quarter basis. There's even stronger. Then take a look at the earnings per share here. See how the earnings per share is just pretty much growing each year. So you have sequential growth. The estimates for 2023 plus 27% with the guidance up as well. Okay, this is really good when you just have earnings per share year over year ticking up, kind of steady eddy, ticking up. Institutions love that, especially when the estimates are up for subsequent years and the guidance is up as well. So it's earnings, it's sales, and it's estimates. 3 most important fundamentals, I think, for growth stocks. So let's go back to our Zoom example. So if you look at Zoom here, this was obviously the COVID crash coming through in here, albeit you can't really see it on this chart. Such was the relative strength for Zoom. See this RS line here, just pointing to the sky, really strong. But if you think about Zoom, we looked at this earlier. You have your phase 1 down here, you then have your phase 2 uptrend, phase 3 distributional top, phase 4 decline. Now, this can often confuse people because if you take a look down here, I appreciate it may be a little bit hard to see, but when Zoom is topping out, can you see that the earnings being reported were plus 999% year over year? Zoom was growing at a ridiculous rate. So the earnings actually topped out here at 999%. And then you can see Zoom was actually coming down here. Sorry, I meant the stock was topping out when the earnings are up 999%. And then over here, the earnings are up 713% year over year, but yet the share price is going down here. Earnings are up 560%, yet the share price is going down. Then they're up 48%, 12%, 6%, minus 22, minus 22, minus 23, minus 4, minus 5. What the hell? kind of thing. It really confuses people because they see a massive earnings report coming out, but oftentimes the stock can top at the peak of its earnings. Why? Because the market is a discounting mechanism. So you see up here, the market, and there's such an intelligence in the market, you just have to learn to trust it. I just believe the smartest minds, the smartest computers operate within the stock market. You just have to trust its judgment, and we're going to speak about relative strength later on. So you just really have to trust it, the technical action that you are seeing, and thinking about the context as well. Zoom has run up here from $80 or $60 to nearly $600 up here, and you get massive earnings coming out. But do you see here how as it's building the phase 1 base, earnings go plus 300, plus 400, plus 300, plus 800, plus 275, plus 567, plus 999, plus 999. So what's happening here is the market is a discounting mechanism, and it's discounting these future earnings. So you will commonly see this powerful phase 2 uptrends and really high earnings coming through, and then actually the earnings will kind of peak, and then the market will discount the future earnings of the stock, which are then going to be slowing. And an important thing to note here is the market often views things as, are things getting better or is things getting worse? So here with the earnings accelerating, things are getting better, but then as things start getting worse and the market starts discounting that, that's when you can see that rolling over phase 3 distributional tops. So let's go into identify and the importance of sector and group strength. So I've taken these charts. These are recent at the minute, at the time of filming this video in April of 2023. So what you have here is you have XLK. So this is the technology ETF. And at the bottom here, you have XLF. Now these charts are lined up. This is the financials ETF. Which one is stronger from a technical standpoint? Okay, and remember, I'll come on to this now quickly, but relative strength is the opinion of the market. It's not my opinion, it's not your opinion, it's the opinion of the market. Never go against the opinion of the market. That there is a golden nugget from this presentation. So XLK, see how it's putting in these higher lows and higher highs, whereas XLF looks terrible. See how it failed here? Bearish synchronicity, just horrible candlestick, breaking down. It's below all key moving averages, whereas XLK is above the key moving averages. The trend is clearly up. As the old saying goes, the trend is your friend. The trend is clearly up here, whereas the trend is clearly down here. Then take a look at the relative strength line. You can find this. You're going to learn more about relative strength in about 5-10 minutes time. So the relative strength line, you can get this, it's a search my name on TradingView, you'll find it, free indicator. See how the relative strength line here versus the S&P 500 is turning up, and you actually get these blue dots, 52-week highs, whereas on XLF, see how you've actually got these red dots, 52-week lows, and the RS line is turning down. So the market at the moment, and this obviously changes, the market at the moment is telling you that technology is very, very strong. Now, I'll just read a couple of things out to you. So, William O'Neill, and he wrote a fantastic book, The Bible on Growth Stocks, How to Make Money in Stocks. I'd highly recommend that. In his studies, found that nearly 50% of a stock's move is dependent on its sector and group. So, group strength, sector strength, really important. Stan Weinstein, very good book. Secrets for Profiting in Bull or Bear Markets, would recommend that. My studies have consistently shown that two equal bullish charts will perform far differently if one is from a bullish sector while the other breakout is from a bearish group. Every year there are a few groups that far outpace all others on both the upside and the downside. Don't underestimate the importance of group confirmation. I've seen many chart patterns that were good but not great that turned out to be super performers when they had a powerful bullish sector behind them. Jesse Livermore down here. If you cannot make money out of the leading active issues, you are not going to make money out of the stock market as a whole. The leaders of today may not be the leaders 2 years from now. So Stan Weinstein and Jesse Livermore wrote these two quotes probably about 60, 70 years apart. But the point is, it's about trying to identify what are the strongest sectors, what are the strongest groups, then what are the strongest stocks. And they do not stay the strongest sectors, the strongest groups, the strongest stocks forever. There is always a changing of the guard. Think back to that price cycle. Phase 1, phase 2, phase 3, phase 4. So it's the same with stocks, it's the same with sectors, same with groups. So this is why your analysis on a daily basis, weekly basis is, what are those leading sectors? What are those leading groups? What are those leading stocks? Really, really, really important. So let's go on to relative strength. Why does relative strength matter? Well, relative strength is not my opinion. It's not your opinion. It's the opinion of the market. The market's opinion is the only opinion that matters. Ignore its opinion at your peril. So this here on the top is Enphase Energy, which is a solar stock, and this here is First Solar, which as the name implies is a solar stock. So Enphase Energy, these charts are lined up on the weekly chart. Enphase Energy builds, as you'll now know, a little volatility contraction pattern. So you have one contraction here, two contraction, then it starts getting nice and tight, and see how the volume dries up here. Whereas if you look at First Solar, so Enphase Energy is coming at a base here in early 2019. What's First Solar doing? Well, First Solar is in the context of a downtrend here. It's actually below its 40-week, which is the 200 SMA on the daily chart, being this red line here. Whereas at first, Enphase Energy is in the context of an uptrend here in basing. Now, Enphase Energy, before this base even builds, actually has blue dots, 52-week highs on the relative strength line, whereas First Solar has got 52-week lows. It's got these red dots. So which stock is stronger? So this is about trying to identify the leader in the group. So Enphase Energy goes up 3,700%. Okay, to the peak here in 2021, Jan 2021, whereas First Solar goes up 142% during the same period of time. Would you rather be in a stock that goes up 3,700% or 142%? Which one do you think you have a better chance of making money in? So this here is just an illustration for trying to identify the strongest stock within the group. And this is why this here is so important. The market's opinion is the only opinion that matters. Okay, relative strength, you can see, look at the 52-week highs coming through on Enphase Energy. Look at the 52-week lows coming through for First Solar. The market was telling you what the better solar stock is. So if you're really bullish on a group, if you're really bullish on, say, EV stocks or solar stocks or semiconductor stocks, focus on relative strength. The market will lead you to the best opportunities, and sometimes you won't know why it's the best opportunities. The amount of information the larger operators have in the market compared to you is staggering. You would not believe it. So they are acting upon that information. They are buying or they are selling. Focus on the relative strength. It will lead you to the better areas in the market. So this here is a study. It's my own study. When do breakouts work best? So this wiggly blue line that you see here, this is the NASDAQ composite, and the red line is the monthly 10 SMA. Now for the study, I used the monthly 10 EMA, but on the chart here in Excel, I couldn't get the EMA, I could only get the SMA, but it's pretty much similar to illustrate the point. So in this study, I looked at 3,000 breakouts, okay, 3,000 stock breakouts from 1986 up till 2022. What did I find? Okay, because you've heard probably the saying, the trend is your friend. Well, interestingly, 90.77%, for the purpose of this, 91% of those stocks break out in a month where the NASDAQ composite closed above its monthly 10 EMA. So that is to say, another way of looking at it, only 9% of the 3,000 breakouts in this database occurred when the NASDAQ composite was below its monthly 10 EMA. So the longer term trend being on your side is very important. So you can think about this as a 91% environment and a 9% environment as well. So it's also thinking back to, well, is the general index in a phase 2 uptrend, or is it potentially in a phase 4 downtrend? So thinking about that from the price cycle perspective. So you can see here, you've got some notable bear markets, such as the early noughties, so 2000 to 2003. So these green bars here represent how many stocks were in the database on the monthly breakout, if you like. So during this, and you can see the scaling over here. So in terms of the database down here, you can see that when the index was down on its lows, see how there's hardly any breakouts coming through. But what do you notice? As the NASDAQ composite starts turning around and going into a phase 2 uptrend and getting back above its monthly 10 EMA, see how you have this huge increase in the amount of breakouts in the database coming through. The great financial crash as well, so 07 to 2009, see how as the market pulls back in here and just crashes basically, see how there's hardly any, there isn't any breakouts in this model database. But as it starts turning up, big increase in the amount of breakouts coming through. You can see it after COVID as well. okay, coming through in this area in here as well, that you kind of for a couple of months kind of dries up, and then suddenly you have a huge increase coming through. So after bear markets, there tends to be a lot of opportunities, because bear markets have always led to bull markets, and I think that trend there will continue. But having the longer term trend on your side is very important. So something to look at is the Nasdaq Composite above its monthly 10 EMA or below the monthly 10 EMA, and that will probably factor into some of your analysis. I'm going to talk about that a little bit later on, but that important to know that of your favorite trading books, Davis, Minervini, O'Neill, the Weinstein book, those breakouts that you see in there, 91% of them will be occurring pretty much, because all of those ones that are still actively traded go into this database, is when the Nasdaq Composite is above its monthly 10 EMA. So I think it's really significant. So we've looked at identify. We're now going to go on to the second part, which is control. So controlling a risk. So what is optimal risk? What is optimal reward to risk ratios? And we'll come on to this in a second. Let's actually do it now. So risk versus reward ratio, break even win rate. Okay. Obviously, if you were 1-to-1, then if you had one winning trade and one losing trade, and both of them were 1, then your break even win rate would be 50%. Now you want to risk less than your potential reward. Okay, so you want to have a really healthy risk versus reward relationship, or reward to risk relationship. I'm going to refer to it as reward to risk now. So ideally you want to risk a small amount but have big potential reward. Okay, so if your reward over here, if we go to the far end of the spectrum, if you were to risk 1 unit but you were to get 10 units back, well, your break-even win rate is only 9%. The same then applies to 1-to-5, it would be 17%. 1-to-4 would be 20%. 1-to-3, 25%. 1-to-2, 33%. So if you were to risk 1 unit but get 2 back, you'd only need a 33% win rate to break even. You can see if you go the other way, so your risk is now greater than your reward, you have to have a very high win rate to break even. So ideally you want to be somewhere over here on this end of the spectrum. Consistently, it's very hard to get a 1 unit of risk and a 10 unit of reward consistently to come in, but aiming somewhere here in terms of risking 1 unit to make 3 units or 4 units is very, very good. That is kind of the sweet spot. And of course, you're going to have some outliers. If you think about it on a distribution curve and a bell curve, you are going to be able to then get, with some of the sell rules I'm going to teach you, some of the bigger reward to risk returns coming in. So where you risked 1 unit but actually your reward was 5, or your reward was 10, or your reward was 20, or your reward was 30. That's not going to happen on every single trade, but I think it's very important to have those very big reward to risk trades coming in. So let me just explain this down here. Okay, so this is now looking at optimal reward to risk ratios. So if I said to you, okay, and I'll explain this Goldilocks zone here. If I said to you, okay, you have got, and this is looking at a 10 trade compounded return on investment. If I was to say to you, okay, you have got 10 trades, okay, and your win rate is going to be 40%. And I said, you can determine how much you win and how much you lose, but your gain has to be twice your loss. And you're going to have 10 trades and you're going to have 4 winners, you're going to have 6 losers. And remember, your gain has to be 2 times the size of your loss. If you were to try and maximize and get the maximum amount back, what would you say? Would you say, well, I want my gains to be 50% and I want my 4 gains to be 50% and I want my 6 losses to be half of that, so 25%? Or, well, I want my 4 gains to be 100% and I want my 6 losses to be 50%? Or would you say, well, I want my gains to be 4% and I want my losses to be 2%? What is optimal? And this comes back to trying to optimize, especially when you're swing trading. These kind of figures here are not applicable for day trading. It's much more swing and say position trading as well. But here it is. The optimal, the answer to that proverbial question is winning 20% on the 4 winning trades and losing 10% on the 6 losing trades. That'll give you a 10.2% 10 trade compounded return on investment. So 20% to 10% is the optimal at a 40% win rate. Now, I actually don't like having 10. I don't like having 10% losses. We'll talk about that a little bit later on, but that there is optimal. So this should give you a sense of where are you targeting, where are you aiming, especially on the upside and thinking about controlling risk. If it was the same question, but now it was the reward was 3 and the loss was 1, and I said you've got 10 trades but you're now only going to be right on 3 of the 10. So you're only going to have a 30% win rate. Same question, what is optimal? So your gain is going to be 3 times whatever your loss is. Would you say, well, I would want to win 99% on my 3 winners and I want to lose 33% on my losing trades? Remember, this is compounded. Well, the optimal answer is 21% for the win on those 3 winners, and then your loss, 7%. That will give you a 10 trade compounded return on investment of 6.59%. So this then feeds into your strategy. Where are you looking to optimize? Where are you looking to kind of target your gains? Now, it's not to say when the stock gets to 21%, you hit, I'm going to sell, and I'm going to show you 500 statistics about riding key moving averages a little bit later on. But that there's really important. Hopefully got you thinking about things a little bit more. So let's go into why is risk management of #1 importance, as I try and keep my my voice going. So I've got different scenarios here, okay? This is all the 10 traded compounded return on investment, and on the next slide I'm going to show you what many people probably do, right? So here we've got scenario 1, 50% win rate, and this trader here, and again, these are just hypothetical figures. It's not going to come in exactly like this. It's to illustrate a point. So trader 1 has 5 winning trades, 5 losing trades, really healthy. Their reward is 2 times their risk, so 14% to 7%, and over the course of 10 trades, their 10 trade compounded return on investment, 33.95%. Remember, this is compounded, so it's putting all of your capital into every position, which I do not do myself, and I'm going to talk to you about position size a little bit later on. Scenario 2, this trader now has a 40% win rate, but he maintains the risk versus reward, the reward to risk ratio of 2 to 1. So the gains are 14%, whereas the 6 losses are 7%, but trader still comes out with a 9.2%. So they're still positive because they're maintaining a healthy reward to risk ratio. Scenario 3, this trader now has only a 30% win rate. However, they maintain a reward to risk ratio of 3 to 1. So this time their gains are 9%, but they tighten it up on the downside and they only have losses of 3%. They still are positive, still are making money after 10 trades, compounded return on investment, 4.64%. Over here, scenario 4 with a 40% win rate. This is a little bit more how I kind of trade, that you can have the very big winner come in, and it's kind of 80-20 rule as well, that 80% of your profits are going to come from 20% of your trades, but you never know which one or which trades are going to be the big winners, hence the point of trying to ride the intermediate term trends, because you never know how far they're going to go. So this trader here has a 40% win rate and their compounded return on investment 55.9%. So they only have 4 winning trades. And their 4 winning trades, they have a big gain come in of 50%. They have an okay gain come in of 15%. They have a 10% gain come in, and then they have kind of a nothing. They have a 5% gain come in, and then they have 6 losers. They have 3% losses and 5% losses. But that compounded return on investment is 55.97%. So if you just compare these 2 scenarios, so look at scenario 2, 40% win rate. Look at scenario 4 with a 40% win rate. One trader returns 9.27%, the other trader returns 55.9%. Which trader do you want to be? I want to be this trader, okay? Getting these outsized returns on not every single trade, it's not going to happen. 80-20 rule, very applicable here, and I'm going to explain that. Getting these outsized returns coming in, those big winners where suddenly you get a 30%, a 50% gain, or something like that, is really, really, really important. Let me just see if I can get the highlighter up for you guys as well as I go on here. I don't know if I'm going to be able to do it. Presentation, screen review. Hopefully it will show up on the recording. Anyway, let's keep going. So why risk management is of #1 importance? Well, now we have another 2 traders. Okay, both of them have a 50% win rate. Okay, 50% win rate. That's really, really good, actually, maintaining a 50% win rate. This trader here, though, okay, what are they doing? Well, they're doing the opposite of what you really want to do. They're snatching at small gains. So they have 5 gains, 3%, 6%, 9%, 12%, 15%, but their losses are much bigger than their gains. 10%, 15%, 20%, 25%, 30%. So after 10 trades, the compounded return on investment, they've lost half their capital in 10 trades. This is the danger of having large losses. Stop doing it, okay? Look at this. Okay, this is really, really healthy. This is good trading. All of these are quote unquote good trading, good performance. I really like scenario 4. That is what I shoot for personally. I'm an intermediate term trend follower. Scenario number 2, they have a 50% win rate. And this time they have some big gains coming in. Okay, they've got 25% gains. Wasn't I just saying on the last slide, big gains, outside gains, really important? Yes, but look at their losses. 25%. So even though, and this is where losses work geometrically against you, okay, even though their wins are 25% and they're 50% right, they've got 25% losses. Sorry, 5 trades that have 25% losses. They've lost nearly a third of their capital after 10 trades. Controlling the downside is the most important thing to do when trading. This is why I've written here, why risk management is of #1 importance. Controlling the downside, if you don't get anything out of this video other than that, controlling the downside is the most important thing when trading. So now we go on to the point of controlling, but how many stocks do you want to hold in your portfolio? Well, for me, I want to be concentrated in leading stocks at opportune moments of time. As a general rule, I want to have 10 positions with 10% of my account in each position. I'm just generalizing there, but that there is a good kind of bellwether for me to be shooting for, okay? Around about 10 positions with 10% of my account in each position. I'm actually a little bit more concentrated than that. I usually go for somewhere between 6 to 8, but I just wanted to use something that I think is kind of general and for you to think about as a potential guideline. Now, per position, I want to risk somewhere between 0.25% and 1% of total account equity per trade. So although I'm putting, say, 10% of my account in a stock, I'm not risking 10% of my account. I'm risking somewhere between 0.25 to 1% of total account equity per trade. This means my usual initial stop loss is somewhere between 2.5% and 10%. And actually, much more often, it's somewhere between 2.5% and 5%. Beware of diversifying, if that's a word, and stretching yourself too thin. If you have 30 positions in your account, it is very difficult to track them all and make consistently high quality decisions. I would rather be kind of concentrated, know the stocks that I'm in, know when the earnings are coming out on a day-to-day basis when I'm undergoing the trade management as well, be able to make sound decisions. I find when I start getting above 10, actually I struggle and performance then deteriorates, but that figure may be different for you. Maybe you can rock and roll with 20 stocks in your portfolio, but again, you're going to be much more kind of tied to the index as well. So less than 10, somewhere between 6 and 10 for me personally is the sweet spot. That's for me. Obviously, this is not advice, financial advice anyway. I'm just telling you kind of what I do, general guidelines for myself in a video that I would have liked to see over 10 years ago. So now we move on to the question, well, where on earth do you place your initial stop? So we've got our Davis box analogy. So we're going to be looking at Davis box here, and then Davis box here, okay? So we're going to be going through the mitigation phase here as well. So let's say here, we've got our Davis box, everything we discussed, the volume drying up, tightening up, leading stock, good RS line, strong group, strong sector, all of that. So let's say the entry point is here and we place our initial stop loss here. Let's now put some kind of levels on this. And let me just talk you through the importance of being risk-free. Now, this is a Sun Tzu Art of War. If you read that book and relate everything Sun Tzu is saying back to trading, probably the best risk management book on trading ever written, in my view. So as that's supposed to say, as soon as prudently possible, I want to position myself beyond the possibility of defeat. Livermore also had a really good quote. Men, being traders, who can both be right and sit tight are uncommon. So let's start talking about this. So let's use our Davis box analogy. Now let's put some levels on it, okay? So let's say that our pivot point, this blue line here, is $100. And our initial stop loss is going to be placed at $97. Which is 3%. Side note, I would go just underneath $97, underneath the whole dollar, so like $96.97 or $96.93, something like that. But for the purpose of this, let's say initial stop loss is $97, 3%. Okay, our pivot is $100, our stop loss is 3% at $97. Now we start thinking about the mitigation. So Sun Tzu, Art of War principle. I want to position myself beyond the possibility of defeat, and then I'd add as soon as prudently possible. So in this instance here, What I'm doing is I'm looking to sell 1/3 of the position at $106. So that's going to be 6%, which is 2 times where the initial stop loss is. And we're going to talk about moving initial stop loss up in a couple of, maybe on the next slide. On the next slide, I can see it over there. So we'll come on to that. Let's just imagine that we're free rolling with the initial stop loss. So the free roll levels to stop loss, and I'll take you through an example over here for 1/3 at 2 times. It's half the position at 1 times, 1/3 of the position at 2 times, 1/4 of the position at 3 times, wherever the stop loss may be, assuming your stop loss is in single figures. Remember earlier that we learned about losses work geometrically against you with the trader who was right 50% of the time but had 25% gains and 25% losses. So this is all to do with tight single figure stop losses. So let's work through this example. The pivot is $100, this blue line here. We're going to buy, for this example, 3 shares at $100. And let's imagine perfect execution, getting a perfect fill, which is rare. Total invested is $300. So imagine if the account was, I'm using small figures just to keep it kind of really easy to understand. Imagine if your account was 3 grand. So you're buying 3 shares, which total invested is $300. So you're putting 10% of your account in this stock. So your total invested is $300, but your total risk is not $300 because your stop loss is at $97. So 3%. So you're investing $300 and your total risk is $9, okay? Why? Because each stop loss has $3 worth of risk attached to it. You've got 3 shares times by 3 equals $9. That's your total risk. So your objective now is, or your objective can be whatever it is, but this is my objective. So my initial stop is 3%. So I want to sell 1/3 to free roll the trade, take all of the risk out at 2 times the stop loss percentage, which is 3%. So I'm looking for a 6% gain. So therefore, I'm looking to sell 1/3 at 106 up here, 6%. So if I sell, remember 1/3, we got 3 shares, so it's 1 share. So if I sell 1 share up here at 106, that means I've locked in $6 profit, okay? Now my total risk left on the trade, well, I've got 2 shares, each with a stop loss at $97, and I bought them at 100. So each share has $3 risk attached to it. 2 times 3 is 6. So I have total risk left, $6 on the 2/3. But remember, I've got $6 profit locked in. So my $6 profit minus my $6 risk equals $0. Free rolled, okay? That there is how I think about it. And then Livermore point, traders who can both buy right and sit tight are very uncommon. So what I'm trying to do is free roll into the first pop after the breakout, sit through the test. Also, Minervini refers to these as natural pullbacks, natural reactions, and then you get the kind of the tennis ball action, okay, where you then want to see it reverse and then make a series of higher highs and higher lows. And I'm trying to ride the intermediate term trend, and we will talk about intermediate term trend selling rules in the optimizing profits. So hopefully that there explains a little bit of the risk mitigation math for you for 1/3, and you could do the same exercise with 1/4 at 3 times, half at 1 times, but for me the sweet spot is selling 1/3 at 2 times. And so let's now add a little bit of complexity to this. So let's say we're looking at a pocket pivot, a low to mid pivot, and let's imagine this is our 50 SMA again. So what we're going to do here is we're going to say, right, we're going to buy at the pivot point here, which is a little bit of kind of a downwards trend line breakout as well, and our initial stop loss is going to go underneath the low of these final 3 contractions. However, we see that within the base there's overhead supply, there's a logical high in the base where price may stall. So if we look at this orange line here, this dash line, this is going to be our free roll target area into this local high in the base. So therefore it may not make sense to sell 1/3 at 2 times the initial stop loss, because a move into here, say if our stop loss is placed here at 5% and this gain is 5%, well, I'd need a 10% gain. However, as the trade starts developing, I see that, well, there's this really tight final contraction in here, and there's also the 50 SMA. So as price starts moving out and approaching this free roll target, well, this could be 2.5% and say that I'm looking to sell here at 5%. Why don't I move my stop loss up on 2/3 of the position, okay, so imagine with that kind of AMD example, if we've got 3 shares, well, we're looking to sell 1 share here and then move the stop loss up to here on the remaining 2 shares, so 2/3 of the position. That means that our stop loss would be 2.5% and we're selling at 5%, therefore we can free roll, sit through the test, and now we free roll. So then if it pulls back and we get stopped out down here, break even on the trade. Hopefully that makes sense to think about. You don't always have to look to free roll where the initial stop loss is. There may be a prudent opportunity to push the stop loss up, which means your free roll target percentage comes down because your stop loss is now smaller. So it's about 2 times where the stop loss is or could be moved to. So optimize what you didn't learn about selling. Now, Ed Seykota is actually probably the greatest trader in the last 50 years, maybe since Livermore. Okay, read absolutely everything you can about Ed Seykota. If you don't get anything else from this video, go and research Ed Seykota. Read everything, listen to everything, and listen to this song, the Whipsaw song, because I'm going to teach you about a couple of Ed Seykota rules. So remember when we were looking earlier, okay, about the returns and the difference that 150% gain had, the outsized return coming in. It's so important. Okay, now this is Kaba. And what I use is so see how it powers up here, look at the volume coming through, and then it builds this cup and handle with a low pivot. You get this trigger bar sitting on the 10 EMA, really tight bar. Volume dries up, that means I can control my risk as well. Okay, this one here, I actually missed this trade. I don't know how I missed this trade. But then here, this is the 10 EMA. This black line is the 10 EMA, and the blue line here is the 21 EMA. The purple line is the 50, the grey line is the 100, and the red line is the 200, okay? So what I look to do is ride the 10 EMA, the black line, and also ride the 21 EMA, being the blue line here. So you can see a gain of 318% before it closes below the 10 EMA, and a gain of 433% before it closes below the 21 EMA. Getting these ones right with a decent size of your position, so say still 2/3, because you'd sell 1/3 into this pop, and then you're just sitting and riding that intermediate term trend. Really important. So as Ed Seykota said in the Whipsaw song, what do we do when we catch a trend? We ride that trend right till the end. So you've got to have sell rules to keep you in the trend and get out of the trend. For me, that's 10 EMA and 21 EMA, but I am going to teach you when to break those rules. OSTK, this is another one, and this is speaking about the 80-20 rule. So the 80-20 rule is very applicable to my trading. Likely 80% of my profits will come from 20% of trades. So imagine if I take 250 trades in a year or 250 trades over the course of 2 years with a 40% win rate, I will have 100 winning trades. That means 80% of my profits will be made from just 20 out of 250 trades. 20 out of 250 trades, and guess what? They'll likely cluster together during a really favorable market time. Patience. You have to have patience. You have to have patience to wait for the setups, patience to be in the right market environment, patience to take the setups, sit in the stocks, just patience. And you see here, this is overstock. So I actually bought this one here. I'm going to talk about this in terms of, I actually sold it on this day. It was this day or this day in here for like a 35% gain. Pointlessly, I didn't need to. Then the stock goes up 319% before closing below the 10 and 21 EMA. 10 and 21 EMA, really important for me for the intermediate term trend. Really important. So this is statistics. So this is looking at 500 different trades. I was going to show you the Excel sheet entirely, but I thought it would just add complexity. So this is basically the summary here. There's 500 trades in this database. Now, I was eyeballing it for, okay, where would the initial stop loss be? And the initial stop loss came in for these 500 trades at 4.95%. And that there is kind of what I would expect in terms of initial stop losses, around about 5% when you're swing trading breakouts from VCPs, flags, cup and handles, all of that stuff. Then what I looked at is, okay, what was the percentage gain on the first close below the 10 EMA, and same for the 21 EMA as well. Well, the percentage gain was 28.82%, and for the 21 EMA was 42%. That is the average gain on a close below the 21 EMA for these 500 trades, same for the 10 EMA, and then here is the 10 EMA and 21 EMA, the reward to risk ratios. 5.71% and 7.82%. So this is why I use the 10 EMA for, so I'm looking to sell 1/3 to free roll, and then 1/3 on the 10 EMA, and then 1/3 on the 21 EMA, and try and ride those trends. So optimizing tactics. This is Jesse Livermore. After spending many years in Wall Street and making and losing millions of dollars, I want to tell you this. It was never my big thinking that made the money for me. It was always my sitting tight. This is in the context of two things. Number one is waiting for the right setups, sitting, waiting for the right setups, waiting for the right market environment, and then sitting in your position, riding the trend. So for me, I'm an intermediate term trend follower. So I'm trying to have sell rules in place that help me ride the intermediate term trends. Now, Ed Sakota had 5 trading rules he lived by. Number 1, cut losses. Number 2, ride winners. Number 3, keep bets full. Number 4, follow the rules without question. And then number 5, which we're going to talk about here, know when to break the rules. Tesla. Okay, Tesla breaks out from some really nice bases in 2020 and 2021. This is when I break the rules, okay? So you see the black line here. Imagine if you bought the breakout coming through here. It's quasi little Davis box in here, okay? And I was actually in this stock for this move here. This is when Elon tweeted about selling. You can go and look at it. This is when Elon tweeted that he needed to sell. He did a poll on Twitter about selling X amount to pay a tax bill. I think it was like 5 billion or something like that. So this is actually Elon selling in here, okay? A fairly significant event as well in terms of a catalyst. But looking at this here, comes out of this Davis / flag type box, volume dries up, and then see how it just rides the 10 EMA and the 21 EMA. But Tesla goes from about $270 up to over $400, really high relative volume coming through. Now this is extended, this is a climactic move. So where I then break my rules is if I think the stock starts getting really short-term extended and climactic and extended from say the 10 EMA, I will choke some off. I may do it on the entire of my remaining position, or I may do it on say part of the remaining position, depends how it plays out. But what I will do is go lower the bar, 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 lower the bar. So low of the bar on the time frame that I'm trading. Invariably on the daily chart that will be lower the day, lower the day, lower the day to choke it off. I don't want to guess when the stock is going to top out. I will, as Davis said, let my stop loss decide. So if it starts getting extended like up here, I will go lower the day, lower the day, lower the day, lower the day, and choke it off that way. That is when I break my rules, okay? So now I want to talk about the importance of view. So the dark side of trading. So this is just being honest. During your trading career, you're going to experience pretty much every emotion possible, okay? Especially the kind of bad emotions, if you like. You are going to experience bouts of anxiety, you're going to experience bouts of depression, high levels of stress, anger, embarrassment, scared, fear, upset, sad, disappointed, jealous, envious. Every emotion that you could possibly experience, the market is going to make you experience it. And this is something where kind of mental resilience and trying to build it. And the mental side is one of the sides that I struggle with most. I've recently been diagnosed with ADHD, and mentally I struggle with things, and sometimes I can get those kind of feelings of anxiety that are really high, of self-doubt, of insecurity. Am I good enough? Bouts of depression. All of these things, you are going to experience them. You're going to be tested in every way. And where it's different to kind of high levels of sport is you're going to experience this every day. The market is open 5 days a week, pretty much. Okay, it's every day. You're going through this on a daily basis. Honestly, trading is probably the hardest professional endeavor you're ever going to try. So you have to be aware of these quite serious bouts of anxiety, depression, that you're likely to experience. You need to understand that, and it's important to communicate with people around you. I actually think I have a fantastic wife who is extremely supportive and understanding, and she knows that there's going to be times where I am struggling with anxiety. I am struggling with thoughts of self-doubt, with insecurity. Am I good enough? Jealousy, because I see, well, other traders are in that trade. Why aren't I in that trade? How did I miss that? You're going to experience all of this. You're going to go through it. So I'll teach you in a couple of slides some things that I try and do on a daily and weekly basis to help me with the kind of the dark side of trading that very few people talk about, actually. So it's about trying to think of mindset is a skill set. So would you read a book on swimming and expect to improve your swimming skills? Probably not. Would you read a book on golf and expect to improve your putting? Probably not. So in the above examples, our knowledge will likely increase. Your knowledge of how to putt, how to swim, breaststroke, butterfly, swimming backwards, so on and so forth will increase. But knowledge and skill are different. So there's knowledge and there's skill. Most of us read a book on mindset and mental health and expect our skills to improve. Our mindset is a skill we must work on and improve with deliberate skill acquisition. So we want to have knowledge, yes, but then we want to have skill acquisition where we're actually deliberately improving our skills. So we'll come on to a couple of things, but also the importance of internal dialogue and belief systems. Now, I would actually recommend listening to, there's Dr. Joe Dispenza. He's got some very good audio books. There's some very good YouTube videos as well. And one of his quotes that really stuck with me is, your personality creates your personal reality. So it's about empowering yourself and taking responsibility as well. What are you feeling on the inside? What are you doing? Because that's likely creating your personal reality. So that just really stuck with me. Then if you think about Confucius, the man who thinks he can and the man who thinks he can't are both right. Royal Marines Commando, it's a state of mind. All of these here are very, very different kind of people and organizations. Joe Dispenza, Confucius, around thousands of years ago, Royal Marines Commando, arguably one of the most elite fighting forces in the world. And what are they all saying? Your mind is extremely important. I could fill 1,000 slides with quotes on the importance of your mind, but I don't need to. These three do enough. Your mind, extremely important, extremely important. This is another quote from Ed Scota, arguably the greatest trader in a long, long time. One of the best ways to increase profits is to do goal setting and visualization in order to align the conscious and subconscious with making profits. Something that I have done is I have a tendency to self-sabotage, okay? And this goes back to internal belief systems, inner dialogue and things like that. So I have a tendency to self-sabotage, and actually I have to do a lot of work, a lot of meditation on myself to improve that and not self-sabotage. And when I heard this quote from Ed Scota, it really hit home because I knew the importance of mindset. But then when I heard Ed Scota say this as well, it just really resonated. Actually doing the goal setting, doing the visualization, okay, aligning the conscious and subconscious mind. I know it may sound a little bit woo-woo, but then this is where the Dr. Joe Dispenza comes in as well. Your personality creates your personal reality. Can we improve your personality to improve your personal reality? I think it's extremely, extremely important. I really, really do. I think it's I think really working on yourself. There's another quote by Jim Rohn, who's mentor to Tony Robbins, who said, if you work on your job, you'll make a living. If you work on yourself, you'll make a fortune. So working on yourself in terms of improving yourself, improving your mindset, improving how are you interpreting things, how are you seeing things. So these are some things that I do on a daily and or weekly basis. So meditation, most of you have probably heard about Wim Hof and the breathing exercises, and then holding your breath. Visualization, cold water therapy. I have a cold plunge in the garden. I try and go in it three or four times a week for around about 5 minutes, because of the ADHD as well. Releasing dopamine, releasing norepinephrine as well, for me is really, really important. Exercise, walk, stretching, yoga, diet, intermediate fasting, being outdoors, doing things that make you happy. A lot of kind of top athletes, they have a different hobby. A lot of them, it's golf, because when you're doing golf, you're kind of on the course, you're kind of away from things. So again, thinking about you, relating this back to you, but doing things to improve your mental performance. But some of the big ones there: meditation, visualization. Yeah, I would say the cold water therapy, really, really key as well, actually, because if you can stick yourself in cold water and you can sit there, then you can follow your cell rules. Mental training, mental resilience. My biggest mistakes. So a lot of you can probably relate to these. Not cutting losses, believing in stories, listening to others, not listening to the market, taking bad random trades, selling a winner too early. That's really my biggest mistake over the year, actually, is selling winners too early. Selling a winner late, terrible mindset, paying the price of ignorance, and not working on myself. So I will just give you, there's a little bit of kind of a cycle here I think people go through. A lot of you probably would have started believing in stories. You start listening to what are people saying on Twitter, what are, in the UK we have bulletin boards, so what are people saying on the bulletin boards, and all of these kind of things. You then start to realize that actually listening to stories is a really bad way to go about things, and then you get into things of, then you fall in love with the stock, so you're not cutting your losses, you're then listening to others. So again, confirmation bias and cognitive biases. Okay, you believe in the story. Okay, the stock goes down, so you're down 5%, 10%, okay, 15, 20, 25, 30%. So you're not cutting your losses. You then start looking for information on the internet to confirm why you're right. So you start listening to others, reading articles, why your stock is the best stock from sliced bread. So then you're not listening to the market, and maybe you're emotional, so you took the trade, but it wasn't actually one of your setups. Okay, terrible trading mindset that you're just digging in, you're just ignoring the opinion of the market. You think you are right, that you are right. The market has to agree with you. You see how a lot of these things are interlinked, but these are the things that you have probably experienced as mistakes, and you can work on them. You can work on improving them. So the power of compounding. Okay, now this is where we're going to go into compounding, and I actually just want to show you a slide, one forward. Okay, this is the power of compounding, and I want to make this a little bit more relatable right now, and then we're going to go back a couple slides. So that 30 grand car that you're thinking about buying, okay, is it worth $500,000 to you? Is that 30 grand car you're looking at worth $500,000 to you? And you're like, what do you mean? It's not 500,000, it's 30 grand. It's not. 30 grand compounded at 10% for 30 years is 523,000, $500,000. So this is the power of compounding. So that 30 grand car in 30 years is going to cost you, the opportunity cost, $500,000 if it just compounds at 10%, which is the historical return of, say, the S&P 500 or the NASDAQ. Is it worth $500,000? Hopefully this is really sinking home about the power of compounding and looking at things as a marathon, not a sprint. Not everything is a sprint. I have ADHD, and this is something I really struggle with because there's no time element. With ADHD, you can't kind of think out logically. It's just how the brains are wired. You can't actually kind of think out logically and see a series of time. So graphs like this for me are really important to make me understand the time element and continually remind myself this is a marathon. It's a marathon. So when I'm in a shop, okay, and I see a nice pair of trainers, okay, are those shoes, those $500 shoes, or £500 for me because I'm in the UK, are those £500 shoes worth 58 grand? Would I pay 58 grand for those shoes? And when you start thinking about things like that and you start to realize the longer term effects, okay, you come away from instant gratification and you start thinking about the long game. Think about the long game. The wealthiest people I know, they think about the long game. They play the long game, always. They always play the long game. So are those $500 shoes worth 58 grand to you? Because $500 compounded at 50 grand, at 50 grand. Those $500 shoes after 50 years compounded at 10% annually is 50 grand, 58 grand. So say if you have kids, or maybe you're in your 20s or 30s or 40s or something like that, and you're looking at, yeah, this coat looks really nice, this bit of jewelry looks really good. 50 years from now, is it worth 58 grand to you? And obviously we have kind of spending sprees on things like that, and I think thinking about things like this is really important, especially for your investments as well. I'm not saying do not buy anything nice. I'm saying just realize the longer term opportunity cost, the longer term cost of things. It's so important, and this is how Buffett made billions. So if we look here, okay, we've got some different scenarios. Okay, now trading does not happen like this. You do not get perfect 2% returns every month, 4% returns every month, 6%, 8%. It doesn't happen like this. It's just to show you the math and make those bigger targets that you probably have more kind of stepping stones that you then realize that, oh, okay, the secret to this is doing this over a long period of time and being consistent. It's not about being really good for a week. It's about being really good for decades. So if you were to compound 2% per month, that then means, so your monthly returns are 2% and you compound that, your year-to-date return at the end of the year would be 26.82%. Remember that the S&P 500 historically is around about 10%, okay? If you were to do it 4%, 60%, 6%, 102%. So for a triple digit year, you just need to average 6% per month. break it down, make it achievable. Reverse engineer the goal. 6% a month over 12 months, 102%, 101.22%, triple digit year. 8% will get you to 100, 150% if you did 8% on average over the course of the month, and obviously didn't then blow it up. So let's just take the lesser one. So let's say you're starting off with 100 grand. And I said to you, okay, in 30 years time, you could have 102 million in your account. What do you need to do every year consistently to get there in 30 years? It would just be 26% a year, which would be averaging 2% a month. So have that longer term target, but reverse engineer it, break it down, make it realistic, make it achievable for yourself, and start then focusing. So there's a really good quote by James Clear, okay? It's not the goal. You do not rise to the level of your goals, you fall to the level of your systems. What are your systems? What are your systems that over the course of a long period of time, you can consistently achieve those returns? Now, it's not going to come in that you get a 26% return year after year after year after year. I'm not saying that, okay? I absolutely know that's completely unrealistic. It's never going to happen like this, but it's just to try and get you to think about what are your systems in place. If this is my longer term goal, what do I need to average for the next 30 years, 20 years, 10 years? What does that then mean I need to average on a yearly basis? What does then that work on say a quarterly basis and a monthly basis? Now, I would not go down to a day, but just to help you stay focused, okay? Because then if I play it forward a couple, let me see if I think I deleted the slide, but it's just not going to come in that it's 2% every month, okay? It might be one month you have a great month, you're up 10%. Next month you're down a couple of percent. Next month you're up 4%. Next month you're down 1%. Next month you're up 5%. Next month you're down 3%. That's much more likely how it's going to come in. Okay, but it's thinking about things not over the course of a year, thinking about things over the course of decades, and thinking about it in terms of a longer series of trades, a longer series of returns. Anything can happen on any given trade on any given day. Think about the longer term perspective, reverse engineer your goals, break it down, okay, measurable steps, then think about the systems and the processes that you are putting in place on a daily and weekly basis, and just get the day right. Days turn into weeks, weeks turn into months, months turn into quarters, quarters turn into years, years turn into decades. Think like that, much more effective. So Warren Buffett, 19.8%, and you can see down here, he didn't make his first billion until he was 53 years old. Now he has, in 2019, over 80 billion. That there, over the course of, 35 years or so, that there is compounding. So remember that shoe analogy that I was showing you? It's compounding. That there is compounding. He's also given a significant amount, 35 billion, it's likely much more now, to charity as well. Really interesting. So compounding. Really, really, really key. And hopefully then this analogy of thinking about, say, a car, or think about your shoes that you're potentially looking to buy, and obviously things could be much bigger than this. You could be looking at a 100 grand car, a couple $100,000 car, potentially a second house that's going to cost you $500,000, $1 million, something like that. Do you really need it? Okay, work it out over 30 years. How much is it going to cost you? Would it be better to just Airbnb things? Would it be better to occasionally rent some things? Interesting, right? So the power of compounding, this is a special forces saying, slow is smooth, smooth is fast. In essence, in trading, it means slowing everything down. So breathe, no rush, no FOMO, focus on your objectives and methodically execute your daily systems and processes. So everything then links back to your daily systems and your daily processes. Okay, so thinking about those things like the Wim Hof breathing method, like cold therapy, meditation, visualization, your trading plan, how are you structuring it? What are your scanning? What is your routine? Okay, Tony Robbins has a great quote: if you show me your habits, I'll show you your life. What are your habits on a daily basis? It's really, really important. So this is deliberate practice. Bruce Lee's quote basically sums it up perfectly. I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. So this is about learning your setup, and we're going to link this back to trading. This is about learning your setups and not practicing 10,000 different entries once, but practicing your entry, your setup 10,000 times, and knowing everything about your entry, how it should act on the breakout, after the breakout, the trending period, and knowing everything about it. You don't need to know 10,000 different setups, 10,000 variations of setups. You just need to know a couple setups that you know inside and out, and you have practiced that proverbial setup 10,000 times, that proverbial kick, sorry, 10,000 times. So deliberate practice, to become an expert performer in any field, basically you have an activity, you need feedback loops, and the quicker the feedback loops, the better. So the quicker you can then learn and implement things, the quicker you're going to learn. And then you plan activity with corrections, improvements. So you're doing, so if you think, let's use a golf lesson, for instance. So you're stood there in the bay, the golf instructor is behind you, you have a 7-iron. So the golf instructor says, right, I want you to hit a couple of shots with your 7-iron, and I'm just going to monitor. So you hit a couple of shots, maybe 5 shots, 10 shots or so, and then what does the golf instructor do? He gives you feedback. Are you doing this a little bit? Maybe he's even filmed you on, say, the iPad or a TrackMan or something like that. So you can now visually see, oh, I'm doing this, I'm doing right. So then the golf instructor is giving you feedback. He's saying, well, you're pulling it away here a little bit, you're coming on the inside a little bit too much, your club face is a little bit open here, your grip is a little bit too strong or too weak here. So now we're creating feedback, we're creating feedback loops. So now we're going, okay, well, this is open a little bit, that's there, that's there. So what the golf instructor is then doing is saying, right, now with the next 5 or 10 shots, I want you to try and do this. So activity, feedback, and then corrections, improvements, and then redo the activity. And you're just creating feedback loops for you to get better and better and better and better and better, okay? But having that feedback and then creating kind of plans of action to improve is really important. So this is why you've probably seen some of the deliberate practice videos on the channel. So there are several things to do in terms of deliberate practice. So all top traders did this one thing. They all did this. They studied the market's own action and created their setup from that study. Studied the market's own action and created their setup from that study. Therefore, they all have their own setup model books. Okay. They then deliberately practiced that setup and improved with feedback from the market. As Aristotle said, we are what we repeatedly do. Excellence then is not an act, but a habit. So what you see all of these guys do, including myself, is we all have chart model databases of certain setups that we trade, and we have studied them. We have thousands and thousands, tens of thousands that we have studied. Now, you've probably seen the bar by bar stuff as well. Now, you can do this nowadays because of technology, and you couldn't do this in the 1970s. You couldn't do this really in probably up until maybe 10 years ago, 5 years ago, really. The bar by bar deliberate practice. What is the bar by bar deliberate practice that you see? Activity, feedback, corrections, improvement. Activity, feedback, corrections, improvement. Activity, feedback, corrections, improvement. That's what you're trying to do. But you first have to have the baseline knowledge of what is the setup from studying the market. Once you then get your setups down, and it's okay, I have this setup, and this setup, great. Build out your model books of those setups, but then go and practice them deliberately, bar by bar. Try and identify them in real time. How are you thinking about then, where are you looking to buy it? Where are you controlling the risk? Where are you mitigating the risk? How are you then optimizing the profits? Really important. So you're trying to get the baseline knowledge, build out your chart model database. These are the setups I like. These are the setups I'm targeting. These are how the trends then play out. This is what happens invariably after the stock. It rides these moving averages. So these are what I'm going to use as the sell rules. Great. Now go practice that deliberately. Study your results, get feedback, and then have corrections and improvements. Okay. Really important. So that there is basically what I was saying. Create your own deliberate practice. And the 4 main areas to improve. So you may find, and this kind of ebbs and flows as well, is that actually at the beginning you struggle to identify high quality setups. What is a high quality setup? And again, this is where you study the market. You can read books, you can watch YouTube videos, but really study the market yourself. Create your own model books. Okay, I love high tie flags. High tie flags are my setup. I love cup and handles. Okay, have your setup. I love pocket pivots, whatever it may be. Maybe you create your own setup. Okay, but do it from studying the market and get tens of thousands of examples. Remember that Bruce Lee quote? Okay, 10,000 kicks once, 10,000 kind of 10,000 charts on that specific setup. That specific setup. You don't want 10,000 random charts on this or this or this. Focus, dial it in, really dial it in. Then the controlling risk. Well, with that setup, what is the optimal way to control risk? Is it underneath the lower the kind of what I call trigger bar, really tight bar? Is it underneath the low, the final contraction? Is it underneath key moving averages? What is it? Then what is the optimal way to mitigate risk? Position yourself beyond the possibility of defeat. Be risk-free on the trade. then what is the optimal way to optimize the profits on that specific setup? What is it? What key moving averages are you riding? What are you doing? Really important. So activity, feedback, plan activity with corrections and improvements. Really, really, really important. So progressive exposure, not often discussed. So the most important thing is your results. What feedback has the market given you on your last 5 to 10 trades? What someone is saying on CNBC or Twitter or wherever does not matter. What do you do? What are your results? Focus on it. So let me give you, because oftentimes people make this just way more complicated than it needs to be. It's not bloody complicated, right? We've got two traders here. We've got scenario 1 and scenario 2. Scenario 1. This trader has a 50% win rate, and over the last 10 trades, this is compounded because it's just easier. Over the last 10 trades, this is what's happened. Okay, they've had a 15% winner, and then they've had a string of losers. 7%, 7%, 6%, 4%, 3%. They've probably had feelings of anxiety, fear, depression, stress, jealous, envious, self-confidence issues, all sorts going through this in here, most likely. Happens with trading. I don't care who you are or how bloody good you are. When you start having a string of losses, you start questioning yourself. You do. Okay. Then they suddenly have a 10% winner, 20% winner, 20% winner, 25% winner. Interesting, right? We'll come back to that in a second. Scenario number 2. This trader has a 40% win rate, and they start off pretty well, feeling good. 15% gain, 10% gain, 7% gain, 6% gain. But then they have a string of losses. 8%, 4%, 5%, 6%, 7%, 5%, and over the last 10 trades, they're pretty much flat. They're marginally down by 0.02% in their trading account. Which trader should get aggressive? Do you see how easy this concept is? It's not bloody difficult, guys, okay? You don't need to get all complicated about it, right? It's this easy. Look at your last 5 or 10 results, lay it out like this, and then ask yourself the question. If I was looking at another trader's results, would I tell them to push harder? Should they be increasing their position size? Should they be trying to get to 100% invested? Should they? Which trader should be pushing it? Should it be the trader that's maybe not quite hitting the ball right at the minute and is struggling to make any progress? Or should it be the trader who's going, wow, crikey, my trades at the minute, I'm on fire, 10%, 20%, 20%, 25%. I'm in tune with the market. The market is rewarding my strategy. When the market is rewarding the strategy, that's the time to be pushing it. When the market is not rewarding your strategy, that's not the time to be pushing it. But guess what most people do over here? They start revenge trading. Okay, they revenge trade. They stop trading with a stop loss. They start increasing their size. In here, okay, Ed Scotto's got another brilliant quote that trying to trade for a losing streak can be devastating in terms of emotional and also to your account as well. So you've got to be aware of, and again, this is going back to knowing yourself, the importance of you. When you're in this losing streak here, okay, I've been here plenty of times. The instinct is, oh, I'm going to make it all back. I'm going to go put 100% of my account in this stock because I'm going to make it back. I'm going to show the market how good I am. I'm not going to trade with a stop loss this time. And then suddenly you've gone oversized in terms of your position. You've got way too much of your account in a stock in a hostile environment because the market is not rewarding your kind of setups, or maybe you were just taking bad trades in here as well. You're just out of sync with the market. Then suddenly you go and put a large percentage of your account in a single name. You're like, well, I'm just going all in Tesla. I believe in Elon Musk, right? All in Tesla, no stop loss. Tesla a week later is down 20%. You are now in a massive hole, and emotionally, you're gone. You've lost it. Okay, so during these times here, peel it back. Trade less, trade smaller size, start getting back into a rhythm, start getting a couple of wins under your belt, start feeling it, confidence comes back in, and then suddenly so imagine if we had here this scenario, and then we overlaid it on this scenario. So suddenly you have a 15% win, and you're like, oh, yeah, okay, right, I'm starting to feel it again. And then you have another string of losses. That there can be pretty emotional, okay? So this is the dark side of trading. You're going to go through these bouts of stress, anxiety, fear, depression, insecurity, jealousy, envious. You're going to go through it all. But then imagine here, now you start getting into, well, hang on a minute. Okay, I was taking some, right, 10%, 20%, 20%, 25%. Okay, feeling it. Right, now is the time for me to be pushing it because the market is rewarding my trades. I'm back in sync with the market. I'm trading well. Stocks are in a powerful uptrend. The index, the sector, the group is really strong. This is progressive exposure. Okay, you don't need to make it too complicated. It ain't complicated. Another thing that I like to do, okay, this here is my current kind of I call it my market health tool and trading plan. Okay, so I look down here. There's a lot more down here, but they're cut off so I can fit it all in. I look at the major indexes, I look at the sector ETFs, I then look at individual ETFs as well for different areas of the market. I look at all the groups as well, and I determine, remember that price cycle that we were looking at earlier on in the video, I determine whether it's phase 1, phase 2, phase 3, phase 4. It could be early or late in that phase as well. And then I look at, is price above or below the key moving averages? What is volatility doing as well? NASDAQ composite above monthly 10 EMA, so that longer term trend is up. I'm currently on choppy breakout environment at the time of filming this. And then the yellow is, where am I seeing a lot of strength in the market right now? So this here I think is very important. Develop it for yourself. Use mine if you want to become a member and all of that stuff. But this here, really, really important. So progressive exposure, analyzing you. Should you be progressively exposing? So sometimes it isn't the market or individual stocks, it's you. This applies to trading well and trading badly. Remember, your personality creates your personal reality. So you can be on top of the world. You can be just hitting it out of the park. You have 5 winners, 10 winners in a row. Things are working great. Confidence is there, high self-esteem, you're just in it. And then suddenly you have 3, 4, 5 losing trades in a row, and then suddenly you're like, your confidence goes, you just start getting emotional, you start getting frustrated, you start getting angry, you start having feelings of anxiety. Again, trading is such an emotional roller coaster. So doing things like meditation, visualization, some cold ferry, the Wim Hof breathing, I think is really, really important. Sometimes it's a bad market, yet you're able to make things happen. Other times it's a good market, but yet you couldn't hit a barn door, as we say. We're all human and emotionals. Emotions significantly affect our performance. Check in with yourself daily and ask a simple question. How am I? How am I today? And if you're not in a good mental state, okay, mental health is so important. If you're not in a good mental state, you don't have to trade. Say, do you know what? I am not there today. I'm just not there today. So I don't want to do any potential significant damage to myself in terms of my trading count, taking bad trades. That's only going to compound that I'm not feeling very good at the minute. And it's okay to not feel good. It's really okay to not feel good. So you just go, do you know what? I'm not feeling it today. I should not be kind of progressively exposing myself progressively in terms of the exposure of you getting more and more into the market. I'm just not feeling it. So do you know what? Today, I'm just going to sit back, I'm going to analyze, I'm going to add more stocks to my model database, I'm going to do some meditation, some visualization, I'm going to exercise, I'm going to go for a cold shower, I'm going to do my breathing exercise, I'm going to spend time with family, I'm going to go play on the golf course, I'm going to see friends, I'm going to get myself back into a better emotional state before I think about trading. It's really, really important. Do not underestimate the importance of you in all of this and kind of what is going on in your head. You can read every trading book under the sun. You can watch every YouTube video on setups. But if you are not there, none of it matters. None of it matters. Final thoughts. Trading is likely to be one of the hardest things you ever attempt. Trading is a skill you acquire and develop. Okay? Knowledge, skill. Knowledge, skill. Acquire the skills. Develop them. If you can't commit 3 to 5 years to the learning phase, this is not for you. It's blunt, but it's true. If you cannot commit 3 to 5 years to the learning phase, this is not for you. It's the same with engineering, law, becoming a doctor, dentist, whatever it may be. It takes time to learn. Why? Because think about it. Activity, feedback, corrections, improvements. Activity, feedback, corrections, improvements. You have to go through this, and you have to go through it in different parts of the market cycle as well. The market cycle for phase 1, phase 2, phase 3, phase 4, phase 1, phase 2, phase 3, phase 4, and learn more about your setup during each of those times. Deliberate practice in some format is absolutely essential. It is, for reasons I just said. Until you have 10,000 charts in your model books that you have studied and annotated, plus taken and analysed 1,000 to 10,000 trades and or deliberate practice trades, I don't think you have a chance. I just don't. I think you're trying to compete in arguably the most competitive environment in the world. You really are. Like, it is. I cannot state it any simpler than that. Okay? Do the work. Do the work. As Stephen Pressfield says, do the work. Trading will be an emotional roller coaster at times. You'll have bouts of anxiety, depression, and stress are common, although not widely spoken about. Look after your mental health. Look after you. Check in with yourself daily. How are you? How are you doing? But I think you can do the work. Okay, understand that trading is a skill that you develop. There are certain things that you can do. Hopefully this presentation has helped you. If you want to learn more about me and my trading, you want to further your education, I have a site that you can go to. You can sign up there if you so wish. So thank you very much for watching this video, especially if you made it all the way to the end. Hopefully you have really enjoyed it, and as I said, thank you very much for watching. I appreciate the support. I'll reply to all of your comments down below. Thank you very much for watching, and I will see you in a future video.